Fantastic. So we got 30 minutes. We have many questions. But first of all, just introduce yourselves in a bit more detail. Start with you, Christopher.
Hi, I represent Mount Logan Capital. We are Hong Kong-based SFC licensed asset manager with specialized in real estate. So we have been traveling to Canada on a very regular basis, and then we bring very niche and some real estate investment opportunity that we believe have extremely favorable risk reward to the Asian investors.
Fantastic. Randall.
No, thank you. Randy Quinn with CIBC, which is Canadian Imperial Bank of Commerce. As a bank, we deal with a lot of the different cross-section, the different sectors in real estate in Canada. As a bank, we provide both advisory services in terms of brokerage, type of activities, M&A, type of activities, but also straight through to the capital markets, both on the equity and the bond side, and also in terms of direct bank financing for real estate related deals as well.
Fantastic. JD.
Yeah, thank you. I represent Landstar Development Corporation. We're a family-owned real estate company out of Calgary, Alberta. We focus on mixed-use real estate in high-value urban areas. So we're the developers. We buy the land, do the land use and zoning, get the permits, build, and then stabilize the asset and hold them most of the time long-term, but we do sometimes sell assets as well.
Great, great. Well, some of the crowd will bounce back in over the next couple of minutes. So is the case. Please feel free to ask questions. I'll start us off talking us through, asking questions regarding investor sentiment, looking at sort of what trends we need to be on the lookout for if you're interested in Canada. Keen to touch upon the affordability crisis that some sectors are having in Canada, or some areas. Probably talk a bit about Albertan independence, the Wessex movement. Yeah, and then looking beyond Tier 1, and then some key advice for investors. Let's start off with you, Christopher. What is current investor sentiment for Canadian real estate?
I think right now the sentiment, it's from an investment point of view, it's turning more cautious, especially in the West Coast, as we see. I think it's all over the news. The capital flows have decreased. And then as a result, we see high-end property have dropped double digits over the past 18 to 24 months in Vancouver. But at the same time, I think there's still a lot of opportunity. For example, the vacancy rate is still extremely low. So if you ask me in tier 1 city, the opportunity right now lies with the more affordable, lower end, probably sub 1 million segment. I think that is still pretty hot going on. But if you are looking for a luxurious segment, I think I will just take a wait and see approach.
Okay. Just touch on, we said it's quite tough, you said. What are some of the factors behind that?
Well, I think there's several factors, and maybe I'll just start and then you can add. Sure. Number one, I think, is the foreign capital flow. That's definitely one of them. And then number two is all the specialty tax that is introduced in the region. Also, of course, is the bank lending situation, which has been tightened significantly over the past 12 to 18 months. I think all these combined together have made the transaction costs and cost of ownership significantly higher in these markets.
Okay. Randy.
I guess I take it from a banker's perspective as opposed to a developer's or an investor's point of view, is that we've actually, in terms of where the transactions have gone, like within Canada, and this is maybe just in terms of trading of assets, there's actually been a fair bit of activity, not as many opportunities like you've described. There aren't a lot of opportunities out there, and a lot of the shifting seems to be from institution to institution. Within the sector, as opposed to necessarily new money coming in particular from offshore. U.S. into Canada, there's still always a fair flow there. In terms of foreign investment into Canada, it's been a bit choppy. Let's say, if I can put it that way. Part of that is because you're mentioning the affordability scale. Things have gotten more expensive. I mean, the Toronto market, Montreal market has heated up. Vancouver has always been progressively more challenging in terms of value investing. But at the same time, what we're seeing on the development side is that in those same markets, though, is that there's a real shortage across a number of different sectors. And that would be on the residential side. On the student housing, for example, I think that might be a bit of a common theme over our conversation here, but also industrial. Again, Vancouver has always been tough just from a land space point of view in terms of being able for there to be actually capacity to build further industrial. So that makes a scarcity. There's a scarcity factor there that comes into play. But in Montreal and Toronto and some of the other second tier cities, if you like, have seen a better balance these days between sort of scarcity of product and accommodation, and which of course, and there's the demand, but at the same time we've seen rental rates also go up in some of these markets. So from a banker's perspective, I might disagree with you a little bit in terms of bank financing availability, or let's say capital markets, because with rents going up, the modeling that we do looks a little bit more favorable these days because rents are going up. There is demand. Occupancy rates for new builds, are filling up. Like pre-renting, pre-leasing, has been good. So I'm a little bit less pessimistic, but it's to get from a value point of view, it's a very tough market. I agree.
Market. How are you finding things, JD?
Well, we're based in Calgary, Alberta, so we are probably a tier 2 city in Canada. We're about 1.3 million people, and Calgary is the heart of Canada's oil and gas industry. So the province of Alberta has the 3rd largest oil reserve on the planet, and right now we're kind of in the opposite scenario to Toronto and Vancouver. Things have been slow since oil prices collapsed in 2014-15, plus delays on various export pipelines that have happened. Things in Calgary on the the residential and office front are fairly slow. So what we're seeing right now is it's the opposite of them. It's extremely affordable in terms of home prices relative to incomes in Calgary. Incomes in Calgary are still very high. It's the highest income city of major cities in Canada by a very wide margin at over $84,000 per capita. And what we're seeing right now is because we don't have the regulatory burden and the land use approval process that is so onerous and burdensome and long and slow that Toronto and Vancouver has. So Calgary is able to increase its supply. So when the economy was booming in 2013 and we had 10% population growth coming in to the city, so in over 100,000 people, or sorry, 50 to 100,000 people coming in, we didn't see massive real estate price increase. They would go up by 5-6% because supply can react. So what we're seeing right now is that it's very, very affordable for people. People are starting to move to Alberta because it's affordable. There's in-migration now, and where we believe that because incomes still remain very, very high in Calgary, that we think right now is the bottom of the economic cycle, and that this is where the classic Warren Buffett, be greedy when others are fearful, that's where this applies. So right now, the affordability crisis of Toronto and Vancouver is not seen in Calgary. There are excellent opportunities to come in and partner on high-quality assets. But given the high supply of real estate, you have to be very choosy with where you go. So for us in our company, we're very fortunate to have centrally located, high-value urban land plays that are always going to be in demand. So we see it from where we're sitting as the bottom of the economic cycle. We're going to start growing soon. There will be 3 new oil export pipelines completed over the next 3 to 4 years, and we're very bullish on the long-term future of the city. So residential real estate is affordable. Office space is very, very cheap, which we have none of. But we're looking forward to growing, and we think it's a great time to invest.
Yeah, so you're saying turn away from the tier 1s, have a look at the tier 2s, and that's where you'll get the best yield in the future.
I think from our perspective, yes.
Yes.
I wouldn't say don't go to a tier 1 city. I would say just be very careful. Make sure you're not buying something that's overly inflated, and go in with an experienced partner that has skin in the game, and I think you can still be okay.
Yeah, fantastic. I mean, in terms of real estate assets, just point this one to Randy to kick us off. I mean, what asset classes are we seeing as the best opportunities for a Hong Kong investor?
Well, I guess I'm not sure if it's the best, but I might call it popular. If you like. Yeah. From what we're seeing, student housing, as I mentioned before, student housing is certainly a very in terms of both the requirement for funding and interest in investing, has been very popular, and the ability to raise money has actually been quite active. In the Canadian market, as some may know, I mean, in the Canadian market, the Canadian university market, right, is one where there's a real significant shortage of student housing, and that's more traditionally just in terms of in Canada, with each of the major cities, the most of the population being centered in the major cities. Most of the major cities have, a 1, 2, 3, or whatever, key universities, in those cities. So from a domestic student point of view, it's not uncommon for students to live at home or to, at least live in the vicinity. Where we're seeing the biggest shift really is in terms of foreign students, coming in. Well, and it's significant. I mean, it's and not just significant. It's overwhelming in terms of what the capacity is, for property and for available rentals, in the cities, where you tend to have in each of the sort of university towns, you'd have your student ghetto, where there would be housing or apartment buildings or whatever that would be renting out, to the student population, and it tends to be clumped in certain areas. And that's not uncommon. Now, but with the sharp increase in foreign students coming in, that capacity is non-existent, and so with that kind of demand and with the rents that they can actually, if you look at building an apartment building, and in terms of the number of units you can have in an apartment building versus to house students, and you look at student housing, the economics are significantly higher in terms of dealing with a student housing facility than you would in terms of building an apartment, right? And so that's where that dynamic is just kind of snowballing in terms of what, again, the demand, the rental rates, and how many students you can put into a student housing, versus an apartment building, is quite appealing to investors and to developers, I would think.
Yeah, and again, it's quite long term and counter-cyclical and.
Exactly.
Yeah, fantastic.
Yep.
Christopher, coming back to from an investment perspective, I mean, where are we seeing Hong Kong capital flow when it comes to Canada?
I think right now it's because Hong Kong capital flow is still considered foreign, and I think most people are still trying to go to Tier 1 city. They are more familiar with the Tier 1 city, but I would advise my client to be extremely selective in terms of asset class. And then personally, I concur with what JD say. I think the opportunity actually lies in the second tier city, because exactly it's like the Warren Buffett way. Right now it's not on the mainstream radar screen, and then if you just look at the numbers, the numbers cannot lie. The numbers basically have implying an extremely favorable risk reward. In terms of asset classes, I also concur. Like student housing, it's something that it's going to, I think it's going to remain a favorable theme for the next 3 to 5 years, because in all these cities, it's basically it's impossible to build. So this shortage is likely to remain unless we see a massive reverse of international student going to Canada, which I do not expect to see anytime soon. So this theme I see, I travel from East Coast to West Coast, and this theme it's very common from Vancouver all the way to Halifax. For example, in UBC alone, there is a 6,000 people waiting list for student housing. There's a good chance these students will have graduated before they can find a housing. And at the same time, if you go to Halifax, which is a 500,000 population city, they have 6 universities, and then 2 of the major universities in the area called South End. It's completely packed with single family. As we all know, we are all property investors. It takes decades to redevelop single family regions, and so I think this student housing it's going to be something should remain on the radar screen of investors for many years to come.
Yeah, I mean, you mentioned Tier 2 cities. Are there any other cities that you want to mention? You mentioned Halifax. We talk about Calgary.
I think, well, Calgary will right up there for several reasons. Number one, it's Calgary have the affordability and have the fundamental story, and then also I think from an international capital point of view, we also should consider the liquidity. I think unfortunately Canada, it's the population and the market size is a fraction of what we see in, let's say, the States. And so outside of Vancouver and Toronto, the Tier 1 city, the liquidity goes down very fast. And so even though I think the opportunity lies with the second tier city, I would still try to stay, if I can find opportunities in number 3, 4, 5 city, including Quebec, including Calgary. I think for the liquidity reason, we should stick with those cities.
Yeah.
And which I see abundant of opportunity in, let's say, Calgary today.
Yeah. Sounds great. I have to check it out. Any questions at this stage regarding Canadian real estate? Raphael, no questions? No? Okay, no worries.
Yes, we have a question.
One question, yep.
Maybe highlight what are we seeing? Thank you. Maybe highlight a little bit of what are we seeing with regards to cap rates, and have we seen a decompression in some of those main tier 1 markets? Where have we seen any cap rate compression because of demand? Maybe the 2 of you, 3 of you can actually comment on that.
Who wants to go first?
I can take a first cut at it, maybe. I think we've seen a fair over the, let's say, the past, 2 or 3 quarters. Again, just to look at it, because the things do change so quickly. Over the past 2 or 3 quarters, we've seen a fairly consistent level of stabilization, I think. We're again, there's individual transactions that might throw the needle off a little bit here and there. But for the most part, and this goes both at tier 1 and tier 2 cities, is that we are seeing a flattening out. Basically, I think the days of a fairly consistent, I'll call it decline in cap rates or increase in valuation. Those are a little bit behind us. As I say, I continue to kind of look at the quarterly data on an ongoing basis. And really, you're not seeing. You might see like a 0.1%, 0.2% change in cap rates. Sorry, not even 0.01 or 0.02% change in cap rates. Not even 0.1. From time to time. But again, then it hits a level and it stays flat. Even with the shortage of on the industrial side, on the residential side. Again, most from what I've seen anyway, a lot of the cap rates have kind of hit a level where even with the demand, the supply constraints, we're still seeing fairly leveling off anyway. I guess I'd conclude it there.
Yeah, I think so too, and I think in a lot of the tier 1 cities, they're getting so low that an investor, it's hard to borrow for below those. So leverage doesn't start to make sense, and I mean that's where you're going to see it's like, why am I buying something when my leverage doesn't help me, and it's always a future pipe dream of continued upward valuation. So I think in a lot of those big markets, it's like, how can I make money at a 3 cap? Right, at a 2.75, like that's very difficult. So it depends on where you are. I think one thing that I really disagree with is people saying the Canadian real estate market is X. It's a huge diverse country with massive swings between regions, and I think you really have to look at the regional perspective. So in some of the places where the economy has been slow recently, I think we'll see some cap rate compression. I do. In Alberta, Saskatchewan, some of the other maybe outer tier cities in BC too, you'll see some gradual creeping down of cap rates. But I do agree with Randall that in the big tier 1 cities, I mean, I can't see them going any materially lower, because how do you make money at that? And what are you writing into your pro forma to go to people and say, hey, look, here's how this is going to make you money? It's a very difficult decision for me, and it's very risky, to me. So I think be very select, but I think in some of the outlying areas, again, the second, third, fourth cities, you might have room for 25 basis points of compression over the next few years.
If I could just add just one point onto
please.
it, because your comment on the debt side or on the leveraging side, is one thing that obviously as a banker we look at very closely. The issue there is that where again, sort of depends on what your perspective and how much you watch the the Fed rates and that kind of stuff in terms of what they're predicting what's going to happen over the next number of months. But what we're seeing also is that with the cap, like you're saying, is that with the cap rate so low, and with like our saying sort of internally is like lower for longer. Doesn't mean they're going to be going lower, but they're staying low for longer than we ever would have kind of anticipated, and they'll probably stay low, whatever range that is. I told you before I wasn't going to commit to a forecast on it, but again, we don't see there's some continued pressure to go down, but as in terms of our businesses, on the developer side or on the banker side, we're more worried about it going up than we are worrying about it going down. Down's great, right? but going up, and like you're saying, is what we're seeing, and I think where there's some resistance in terms of the cap rates is that everybody is very cautious in terms of leverage. We're seeing it across the industry. I mean, the developers and and investors are fairly prudent. What we're seeing is that we're not seeing crazy money going, especially in terms of leveraging, and bankers can deal with that. Right, and so in terms of if we were to see, leverage, creeping up and looking at the cap rates, then it becomes, like you're saying, it becomes more and more of a challenge to actually participate in the financing. And so I think there's I think the industry is in an equilibrium level, given how low rate, both rates are.
Do you want to add anything?
I agree with what they say because that's what I'm seeing too. So I think I have very little to add, but I think right now it's if you look at them from the macro side, it's where we are. It's all the major economy is still very accommodative in terms of liquidity. So we have a lot of the pension fund, sovereign wealth fund, and REITs. They still have a lot of capital to be deployed, and then their cost of capital is very low, but these companies, they need leverage to make an investment make sense. And so as the cap rate becomes so low, the positive carry become narrower and narrower. And so I think they increasingly will go down, will go to other places, the so-called peripheral, to look for higher cap rates that they can make the investment make sense. So if this, according to this logic, I think from tier 1 to 2 to 3 city, I think the cap rate will probably level up, just like the U curve.
Great question. Does that answer it, or? Yep. Any more? Okay. I just want to sort of do a bit of a compare and contrast. You talked a bit about where Hong Kong money is flowing. How is Hong Kong capital comparing to Singaporean capital when it comes to Canada? Is there a significant divergence there?
I think part of what we're seeing, because in terms of the markets that I cover out here anyway, it largely, it used to be mainland China as well, but now it's Hong Kong, I'd say, and Singapore are the main sources of investment that I'm looking specifically targeted to Canada. Like it's CIBC is basically Canada to here and here to Canada, if you like. And so what we're seeing is that there's first of all, in terms of familiarity with Canada, the Canadian market, certainly there's a higher level of familiarity out of Hong Kong versus out of Singapore, right? Just in general. The Singaporeans, when you talk about the sovereign wealth funds and other large funds, they've become very, very, from Asia, going to the UK, going to the US, going to Australia, has been a lot more comfortable, if I can put it that way. There's always been, I'd say, a fairly good level of investment from Hong Kong into Canada. Again, because of familiarity, because of whether it's from having been educated there, family there, like whatever else, historical ties. Singapore's a bit of a tougher story. There's the impression that we're given is that the U.S. is well understood. There's a lot of critical mass, in terms of San Francisco, Los Angeles, New York, Boston, like whatever, Chicago. In terms of markets, they're well understood and they're large populations. I don't think there's as high a level of familiarity in terms of Montreal, Toronto, Vancouver, Ottawa, Calgary. They also are. It's a very big country, but very specific markets, that we're bringing to them. But the perception is that Canada is really too big and I can't take on a new market, in terms of going outside of the UK, US, or Australia, for example. But there's a lot of interest because, again, the Brexit in terms of the UK has caused some pause, for some, in terms of looking to the UK. The US, the whole Trump thing and everything else, has been has created challenges.
What a time to be alive.
Yeah. And Canada is again is very friendly for both, and especially in terms of looking to Asia from a taxation point of view, from a withholding tax point of view. Canada is actually more forgiving, in terms of especially coming to Hong Kong and coming to Singapore, compared to the U.S. And these are the type of things that we're having to do a lot of selling, basically in terms of bringing everybody's kind of knowledge and comfort, with the market, up the curve.
Because you touched upon Brexit and Trump and uncertain times. I mean, in Calgary, are we going to see independent Alberta in our lifetime? Is this something that you're factoring in, or is it just hot air?
It's more than hot air.
More than hot air.
But I don't think it's going to happen. So I think what to give you a background, there's been a lot of obstructionary pressure, largely foreign funded from American groups coming in and trying to stop the expansion of the Canadian energy industry. Oil pipelines have been planned for years to both the east and the west coast, and one down into the United States, the Keystone XL. And there is a deliberate foreign-funded, from the United States, campaign against only Canadian energy, nowhere else, not the Middle East, not Russia, nowhere else, just against Canadian energy. They're trying to keep it in the ground, they're trying to keep it cheap, they're trying to keep really our energy industry down. So what's happened is we've got a federal government right now that recently has been very sympathetic to these foreign activists, and they have been very instrumental in helping to achieve the agenda of shutting down the Canadian energy industry. Meanwhile, the world burns more oil every single day than it ever has before. So there is legitimate, serious anger in the provinces of Alberta and Saskatchewan because we're not treated fairly. People don't know this, but every year, or some people do, but every year in Canada, the province of Alberta contributes $23 billion to the rest of the country, more than it gets back in terms of federal services. So what this does, and we're happy to do it, we're generous people, we like to work with our countrymen, it brings the level of government services up around the country from the lower income places into the standard of a higher income place. The problem, though, is that this is obviously fostering a lot of rage in Alberta because they're trying to block the very industry that funds this. And so the level of anger and rage is real, it's legitimate, and it's not going away anytime soon. And I think what you're hearing, a lot of this rhetoric, Wexit and all that, now we all know the practicalities of an independent landlocked Alberta are nil. It's not something that is good for either country, but I think what you're seeing now is a legitimate sense of despair, and people are hopeless, and they're going, you know what, if it's not gonna work for us as part of Canada, we're not any further ahead, let's go it alone. So it's not hot air. I don't think it's going to happen. I think public opinion is starting to wake up and realize now that the Canadian energy industry is the most ethical in the world by a very wide margin. Social and human rights and governance. I mean, who would you rather be, Canada or Saudi Arabia? I mean, come on. So, from that perspective, so no, it's not just hot air, it's real. But I think what's gonna happen is that because it has to be real in order to get concessions from the government. So I don't think it's gonna happen. I don't at all. I don't believe in Wexit, and I'm not a supporter. I don't think it's a good thing. We should not do it. However, we need to be real about going down that path if we're gonna put any pressure on the government. So what I think is gonna happen, and what you're seeing now, is public opinion starting to change. It is across the country, and 2/3 of Canadians recently in the federal election voted for parties that are pro-energy. The Liberal Party is expanding the Trans Mountain pipeline. The Conservatives are, of course, full speed ahead on energy, but you've seen that, and that political will is there for us to realize that oil and gas is going to be in the global energy mix for the next 50 years, and the transition to a low-carbon economy is going to happen.
We need that gas for that baseline.
Exactly, and where would you rather have your energy coming from? A responsible environment and human rights respecting jurisdiction like Canada, the best in the world, or somewhere like Saudi Arabia or Iran, right? So what's happening now, like I say, I don't think it's gonna happen, but it's a tactic that we're using to put pressure on the federal government. They're listening now. The Trans Mountain expansion is under construction, and there is a lot of political pressure to get it done. So I think that, no, so I don't think it's gonna happen. I really don't, I hope it doesn't. But I think that it's something it's a real tactic that is real in Alberta, and it's going to help us ultimately get what we want. And I think it just makes too much sense for us not to ultimately complete the pipelines and continue the responsible growth of the energy sector.
Oh, fantastic. We just got a couple of seconds left. I just want to sort of round everything up and ask the final question. If you're a Hong Kong investor looking to get involved in Canada, what's the one bit of advice you would give them?
First of all, of course, you should look at the opportunity itself. And then secondly, it's very important. And then for people who are in Hong Kong, we often ignore it. It's the tax issue. Because in Hong Kong, I think we are spoiled by very low tax and very simple tax scheme. When we invest into countries like Canada, that can be potentially much more complicated and potentially will affect your return. So
tax.
Tax and
Okay.
tax and tax.
Tax and tax and tax.
That will significantly affect your realized investment.
Partnership.
Yeah, and this is one of the key ways in terms of talking to investors here, and again, I was emphasizing before in Singapore, is familiarity and comfort in terms of investing into Canada is a lot better when you have a partner on the ground. Whether that's from a development point of view, who would have very good knowledge of the market and the regulatory and municipal issues that are at hand, and also funding partners. The ones that have banking relationships or have had access to the market before in terms of raising financing for the projects.
Tax, partnership. Final word?
Yeah, absolutely. I agree with Randall completely. Partnership, your local partner. Who is it on the ground? Are they experienced, and are they investing capital in the projects on the same terms as the foreign investors? I mean, that's do they have relationships? Can they work through the regulatory environment, and do they have a history in what they're doing? So, 100% absolutely agree with Randall. And of course, the tax thing. I'm not as familiar internationally. Of course, you want to minimize your taxes, but I think the selection of the partner is absolutely key. I mean, you can have the best piece of land in the world if the partner doesn't know what they're doing, you're not going to do well. So absolutely make sure that they're aligned on the investment side, significant capital, experienced, and have the relationships to make these things work.
Fantastic. J.D. Lewis, Christopher Yip, Randy Quinn, everyone please put your hands together for Canada Panel. Now we break for lunch.